All right, back again for another deep dive. Today, we're going to be laser focused on loans, pulling all the need to know info straight from our trusty study guide.
Exactly. I mean, chances are you've probably seen most of this material before,
For
right?
sure.
But, well, that's exactly why we're here. We're going to make sure everything really sinks in, all those terms, all those important concepts, making them crystal clear.
So,
Let's jump right in.
yeah, let's do it.
I guess we'll start off with problem loans.
Sounds good.
And I see here the guide kicks things off with, past due status,
Right.
which, we shorthand that as PD.
BD.
And it seems pretty simple. If you've got monthly payments, you miss just one, you're 30 days or more late, bam, you're past due.
Yeah, pretty straightforward. And in general, I mean, the overarching theme is if any payment isn't made by the time it's supposed to be made based on how the loan's structured, well, it's past due. No surprises there.
Okay, so then we move on to leveraged lending.
And it seems like this is all about loans that are used for things like buyouts, acquisitions, that kind of stuff. But it looks like the real defining factor is how much debt is involved.
Yeah.
So what are some of those key debt thresholds that the guide highlights?
So we've got the total debt to EBITDA ratio. Once that goes north of 4x, that's a big one. Then there's the senior debt to EBITDA. Anything over 3x, that's another red flag. And of course, you always have to factor in what's considered normal for that specific industry.
Okay.
But it's not just about crunching the numbers. If the market sees a borrower as carrying a lot of debt compared to their net worth, well, they're going to get labeled as highly leveraged too.
So it's kind of like a combination of the math and how the market perceives things.
Exactly.
Now, when these leveraged loans are being evaluated, the guide really seems to emphasize the importance of enterprise value. Why is that so crucial in this context?
Well, you see, with leveraged lending, enterprise value gives you this really important perspective. It goes beyond just their earnings right now. It's about their overall financial flexibility.
Yeah,
So it's like peeking into their ability to manage all that debt, maybe by selling off assets or, tapping into capital markets. It kind of gives you a sense of their long-term health,
Gotcha.
which ultimately helps determine whether they can repay the loan, even if their immediate cash flow takes a hit.
So how exactly do they come up with this enterprise value? I mean, it's not just like a rough guesstimate.
No, it's definitely not a shot in the dark.
Okay.
The guide's really clear on this. You need qualified, independent experts using proven valuation methods.
Okay.
So they might use an income-based approach, looking at future earnings,
Yeah.
or they might go with a market-based method, comparing the company to similar ones out there. And then there's the asset-based valuation, looking at what the company's assets are actually worth. It's all about getting a solid, objective figure.
So it's a pretty thorough process then.
Definitely.
Okay, so when these leveraged borrowers start running into trouble, the guide mentions these classifications, things like substandard, doubtful, loss. How does this whole enterprise value thing factor into those ratings?
Well, if a borrower doesn't have any realistic way to lower their leverage, that's when the substandard classification starts looming.
Uh-huh.
And if the loan isn't backed by strong collateral or the enterprise value just doesn't seem all that reliable, then it could even get slapped with a doubtful or even a loss rating.
Oh, wow.
So yeah, while enterprise value can certainly help, it's not going to single-handedly save a loan from getting hit with an adverse classification.
Gotcha. All right, let's switch gears a bit and talk about oil and gas lending, specifically reserve-based lending,
Yeah.
RBL.
Right.
And in this case, those oil and gas reserves, they're basically the heart of the whole repayment thing.
Absolutely. It all comes down to how much cash flow those reserves can generate.
Yeah.
And the borrowing base, how much a bank's willing to lend, that's mostly secured by what they call proved developed producing reserves, PDP for short.
Right.
And that's basically the oil and gas that's already flowing.
Now, I see the guide mentions these other types of reserves too. PDNP, PUD, P2, P3. Can you give us a quick breakdown of what each one means?
Sure. So PDNP, that stands for proved developed non-producing. It's oil and gas that's definitely there, but it's not currently being extracted. But the good thing is it could be fairly easy to start producing. Then you've got PED, proved undeveloped reserves. These require some extra investment before you can get to them. And then you have P2 and P3, or probable and possible. Basically, as you go down that list, there's more and more uncertainty about whether you can actually recover those reserves.
So it's like a scale of how sure they are about those reserves.
Exactly.
And I see the guide really emphasizes the importance of those third-party reserve engineering reports. What's the main reason those are so critical?
Those reports, they're like the foundation of the whole RBL underwriting process. They give you an objective, unbiased estimate of how much of those reserves can be recovered and what kind of cash flow you can expect. The guide really stresses that these reports need to be based on solid assumptions, completely independent from the lending process, and the bank needs to have really strong internal controls to make sure they're valuing the collateral correctly.
Okay, let's move on to agricultural loans. Here it seems like the main focus for repayment is the cash flow that comes from running the farm.
That's right. Those intermediate and long-term agricultural loans, they're all about the farm's ongoing income. Usually they're backed by some kind of security, like a general lien on the farm itself. And feeder livestock loans, they follow a pretty similar pattern, often secured by the livestock.
Now, the guide mentions home equity loans and how they're generally considered lower risk because the home's there as security. But it sounds like there's a catch, right?
Yeah, you always have to keep in mind that even if you've got a house backing the loan, things can still go south. Housing values can drop, people's finances can get squeezed, and suddenly they're struggling to repay.
Yeah.
Having that collateral doesn't mean it's a foolproof guarantee.
Good point.
Yeah.
For ag underwriting guidelines, the guide talks about making sure that any money the borrower gets from selling their crops or livestock actually goes towards paying down the debt. Why is that such a big deal?
Well, think about it. Agriculture's got its ups and downs, prices fluctuate, you never know what's going to happen.
Right.
So the bank wants to make sure that when the borrower sells their stuff, that money goes straight to reducing that loan balance.
Yeah.
It's about striking a balance between the borrower's decisions on when to sell and the bank's need to protect their investment.
Okay, I get it. And how are these ag loans classified if things start to go downhill? The guide mentions things like livestock prices and production costs.
Right. Well, if those prices take a nosedive or the cost of running the farm shoots up and the borrower's usual income just isn't enough to cover the payments, well, that's when an adverse classification comes into play. And the guide also points out how interconnected everything is. Sometimes those payments might even be coming from other loans the borrower has at the same bank.
Now, what about those breeder stock loans? Are they treated any differently when it comes to classification?
Generally speaking, if the loan's secured by the livestock and the borrower is making their payments by selling the offspring, then it might not be automatically classified as adverse.
Okay,
I mean, you have to remember, with breeding stock, it's a longer-term game. It's not like selling crops every year.
makes sense. All right, let's jump to a completely different type of loan now. Check and credit card loans. The thing that stands out to me here is the non-recourse aspect of sales drafts that are charged to a credit card. What does that actually mean for the bank?
Basically, once that charge hits the customer's credit card, the bank's the one holding the bag when it comes to credit risk.
Okay.
If that customer doesn't pay their bill, tough luck for the bank. They can't go running back to the merchant demanding their money back.
Interesting. Next up, we have syndicated lending. So this is where you've got multiple banks all involved in the same loan.
Exactly. It's a team effort, a bunch of banks pooling their resources to directly provide funds under one loan agreement. It's not like participations where one bank makes the loan and then sells off pieces of it. This is a true joint venture from the start.
The guide also talks about these things called adversely classified contingent liabilities. What are those exactly, and how does the whole classification thing work?
Well, think of them as potential liabilities, something that might happen down the road. Category I contingencies, if they actually come to pass, they usually lead to an increase in the bank's assets.
Okay.
Like, say a bank commits to funding a loan, that's a contingent liability. And if they end up funding it, well, they've got a new loan on their book, a new asset.
Okay.
But Category 2 contingencies, those are different. They create a claim on the bank's assets, but there's no direct increase in assets. Now, when it comes to classifying these Category I contingencies, it all depends on how likely it is that the event's actually going to happen and what kind of credit risk that potential asset carries.
Okay, makes sense. Then we've got re-aging of loans, which basically means bringing those delinquent accounts back into good standing. What's the main idea behind that, and what are some of the rules involved?
It's all about giving borrowers a second chance. If they can show they're back on track and able to make their payments.
Right.
For open-ended loans, they usually have to make 3 consecutive monthly payments to get re-aged, and there are limits on how many times they can do that. Closed-ended loans have their own rules. They might restrict extensions or rewrites, and the bank definitely can't just add unpaid interest and fees to the principal.
Yeah. So there are some safeguards in place. Okay. That brings us to those loan classification criteria we've been talking about. Substandard, doubtful, and loss. Let's break those down one more time.
All right, so substandard, that's for loans that are over 90 days past due, and they either don't have a strong senior lien or the borrower's net worth, their ability to pay, or the collateral backing the loan just isn't strong enough.
Gotcha.
Doubtful, that's a step further.
Yeah.
That means the bank doesn't think a total loss is imminent, but there's still a lot of risk there. Maybe there's some specific factors that could help the borrower turn things around. And then there's loss. That's the worst case scenario, basically saying the loan's uncollectible and it's time to charge it off.
Okay, so what about those partial charge-offs for non-real estate collateral? How does that work?
So let's say the bank's pretty sure they're going to repossess the collateral. Instead of charging off the whole loan amount, they can write it down to the estimated value of the collateral after taking into account any costs associated with selling it.
Okay, that makes sense.
So they're not writing off the full balance, just the difference between what they're owed and what they think they can realistically recover.
Gotcha. And are residential real estate loans treated any differently when it comes to classifying them based on delinquency?
Yeah, they actually are.
Okay.
If it's a 1-to-4 family property and the loan-to-value ratio is 60% or less, just being delinquent doesn't automatically mean it gets classified.
Interesting.
But even then, the bank still has to get a current appraisal of the property within 180 days of it becoming past due.
Okay. Now, what happens if a borrower files for bankruptcy? How does that affect the classification?
Well, bankruptcy usually triggers a substandard classification right off the bat,
Great.
at least until things become a little clearer. Will the borrower be able to keep making payments? Or will the collateral have to be liquidated?
Right.
And if the loan amount is more than the property's worth, after factoring in selling costs, then that excess amount needs to be charged off.
Makes sense. And what about loans that were made to someone who's passed away? How are those handled?
Well, as soon as the bank determines there's going to be a loss, they need to charge off that loan.
Okay, and last but not least, let's talk about partial payments. How do those factor into the whole past due status thing?
So banks have a couple options here. They can either say, all right, if the borrower pays 90% or more of the payment, we'll count it as a full payment for the purpose of calculating past due status.
Okay.
Or they can add up all the partial payments the borrower's made. But the key is they have to pick one method and stick with it, be consistent across the board.
Makes sense. All right, so we've covered a lot of ground on problem loans. Now let's move on to loans to insiders, that whole rego thing. So first things first, who exactly falls under the definition of an insider?
Well, we're talking about executive officers, directors, anyone who owns more than 10% of the voting stock,
Okay.
also known as principal shareholders. And it's not just them. It extends to their related interest, even their immediate family members who live in the same household.
Okay, and rego puts limits on how much a bank can lend to these insiders, right?
Exactly. For unsecured loans to a single insider, the limit's 15% of the bank's unimpaired capital and surplus. Secured loans have a bit more wiggle room. They can go up to 25% of that same base.
And remind me again, what exactly does unimpaired capital and surplus mean?
It's basically Tier 1 capital plus Tier 2 capital. But you have to subtract any allowance for credit losses that's included in Tier 2.
Okay. Now, what exactly counts as an extension of credit under rego? It sounds pretty broad.
It really is. I mean, obviously, direct loans are included, but it goes way beyond that.
Yeah.
Indirect benefits to insiders, credit extended to companies that they control, overdrafts that go on for more than 5 days. And that's not all. Buying an insider's debt, guaranteeing an insider's loan, even giving them more money on an existing loan, unless it's for specific accrued interest or absolutely essential property expenses. All of that falls under extension of credit.
So it's pretty comprehensive. Are there any exceptions to these lending limits, though?
Yeah, there are a few carve-outs. Like those unintentional overdrafts under $1 million that are cleared up within 5 days. Those are generally okay as long as the bank charges its standard fees.
Mm-hmm.
And there are some specific exceptions for loans to executive officers. Things like loans for education, loans for their primary residence, as long as the bank has the first lien. Also, loans secured by U.S. government obligations or those segregated deposits, up to a certain limit, and often with a demand clause attached.
Gotcha.
But even those exceptions, they often come with their own set of rules. The board might have to be notified. The terms of the loan have to be similar to what regular employees would get. And the EAO might have to provide detailed financial statements.
So there's still a lot of oversight involved.
Oh, yeah.
Now, rego also talks about affiliates. How do they define an affiliate, and why is it important to distinguish them?
Well, an affiliate could be a parent company, any company they control, premises holding companies, even those who hold government securities for the bank, sponsored or advised entities, investment companies, and financial subsidiaries.
Wow, that's a pretty broad definition.
Yeah, it is. And the reason it's so important is because there's this whole other set of regulations that kicks in when you're talking about transactions between a bank and its affiliates. That's where Regulation W comes in.
Regulation W aimed at making sure banks aren't being used to give an unfair advantage to the owners' other businesses, right?
Right.
So Reg O is all about those direct insider deals, and Reg W, specifically sections 23A and 23D, those are the ones that govern how banks interact with their affiliates.
Exactly. It's all about making sure the bank's being run fairly, that it's not just a tool to benefit those connected companies that are controlled by insiders.
So how do they determine what control means in this context when we're talking about affiliates?
There are a few ways. If someone owns or controls at least 25% of the voting securities, that's control. Or if they can choose a majority of the directors, that's control too. Even if they don't have that kind of direct ownership, if they can exert a controlling influence over the management or the policies of the company, well, that's considered control as well.
Gotcha. And what types of transactions between a bank and its affiliates are considered covered under Regulation W?
It's a pretty long list. Loans, of course,
Yeah.
but also buying assets from an affiliate, investing in their securities, taking their securities as collateral.
Uh-huh.
And then you've got things like derivative transactions that create credit exposure, securities financing, and even issuing guarantees or letters of credit for the benefit of an affiliate. All of those fall under the umbrella of covered transactions.
Okay. Now, are there any limits on how much a bank can engage in these covered transactions with their affiliates?
Yes, definitely. For any single affiliate, transactions are capped at 10% of the bank's capital and surplus. And when you add up all the transactions with all the affiliates, that total can't go over 20% of that same capital and surplus base.
Okay, so there are definitely some boundaries in place. Now, I see that Regulation W also lays out some pretty specific collateral requirements for credit transactions between banks and their affiliates.
That's right. Generally speaking, any credit that's extended to an affiliate has to be backed by collateral. And the amount of collateral you need depends on what type it is. For obligations issued by states or political subdivisions, you need 110% coverage. For other types of debt, you're looking at 120%. And for things like stock, leases, or other real or personal property, you need to have 130% coverage. Okay. And there's also a list of things that are strictly off limits as collateral. Affiliate guarantees, low-quality assets, even the bank's own regulatory capital instruments, those are all no-goats.
So they're really trying to ensure that the collateral is solid.
Exactly.
Now, are there any cases where these rules for affiliate transactions just don't apply?
Yes, actually there are. Transactions between sister banks that are both under the control of the same parent company, typically with at least 80% ownership, those often get a pass. Correspondent deposits, loans that are fully secured by the U.S. government, those segregated deposits we talked about earlier, riskless asset purchases,
Yeah.
and loans that the bank originates but then sells off to an affiliate with a repurchase agreement in place.
Yeah.
Those types of transactions often don't have to follow those quantitative limits, the collateral requirements, or even some of those qualitative rules.
Gotcha.
But even then, safety and soundness, those core principles always apply.
So even with those exceptions, banks still have to be prudent and responsible.
Absolutely.
Okay, so before we wrap up this whole Reg O and Reg W discussion, are there any other general prohibitions we should be aware of?
Yes, a couple of key ones. First off, any loans to insiders, they can't be offered on better terms than what a regular non-insider would get.
Okay, so no preferential treatment.
Exactly. And the other big one is that any time a loan to an insider, plus any credit extended to their related interests, goes over a certain amount, the board has to give their approval before that loan can go through.
Makes sense. And to make sure everything's above board, that insider can't have any say in the board's vote, right?
That's right. No undue influence allowed.
Okay, that's a lot of info on insider and affiliate loans.
Yeah, it is.
Let's switch gears one last time and talk about asset concentrations. What are some of the red flags that would require a bank to do a written analysis of their asset concentrations?
So if a lot of their assets are tied up in obligations from a single municipality or a group of related municipalities, that would definitely trigger an analysis.
Okay.
Also, if they're holding a lot of non-agency securities, those would need a closer look. And then there are those situations where their assets are concentrated in a small, interconnected group of borrowers.
Mm-hmm.
Or maybe a lot of their loans rely on a single source of repayment, or they're all focused on a specific project, or a certain type of collateral, or even a particular industry. All of those scenarios would warrant a written analysis to assess the risk involved.
So it's all about diversification, making sure they're not putting all their eggs in one basket.
Exactly. The analysis would look at things like the economic drivers behind that concentration, the risk levels involved, and how well the bank's managing those risks.
Okay, now are there any specific thresholds that trigger the need to report these concentrations?
Yes, there are. But it's important to remember those thresholds are mainly for reporting purposes. They're not necessarily hard limits.
Okay.
For credit-related concentrations, those thresholds are often calculated as a percentage of the bank's Tier 1 capital plus their allowance for credit losses. Non-credit-related concentrations, those are usually measured as a percentage of Tier 1 capital. The exact percentages can vary, but banks need to keep a close eye on these concentrations and make sure they're not getting out of hand.
So even if a concentration's below those reporting thresholds, examiners could still flag it as a potential issue, right?
Absolutely. They're always looking for any signs of trouble, regardless of whether a specific threshold's been crossed or not.
Okay, now what about funding concentrations? What would trigger an analysis of those?
So if more than 10% of a bank's total assets are coming from a single funding source, that's a sign of a potential funding concentration risk. And that definitely warrants a closer look.
All right, last but not least, let's talk about appraisal regulations. Remind me again of those three main approaches to valuing property.
Sure. So there's the sales comparison approach, which is considered the most reliable method for owner-occupied residential properties.
Mm-hmm.
Then there's the cost approach, but that's not always the best fit, especially in troubled real estate markets. And then there's the income approach, which focuses on the present value of the property's future net operating income.
Okay, and the interagency guidelines for real estate lending policies, those play a big role here, right?
Absolutely.
Specifically Appendix A to Part 365.
Right. That's where they lay out all the requirements for appraisals.
Okay.
They have to be either complete appraisals, which means they have to comply with the uniform standards of professional appraisal practice, U.S. GAAP, or they can be limited appraisals, but those come with their own set of rules, potentially allowing for what they call departure provisions. And the guidelines also mandate something called ADU.
ADD, what's that all about?
It stands for Administration, Diversification, and Prudent Underwriting.
Okay.
And that includes setting those loan-to-value limits, or LTV limits. The important thing is that the bank's own internal limits can't be any looser than the supervisory limits that are set by the regulators.
So what happens if a bank does make loans that exceed those supervisory LTV limits?
Well, they have to keep track of the total amount of those loans and report it to the board every quarter. And generally speaking, that total shouldn't be more than 30% of the bank's total capital.
Okay. Are there any types of loans that are exempt from those LTV limits?
Yes, there are. Quite a few, actually. Loans that are backed by the U.S. government, those that are immediately sold off without recourse, renewals of existing loans that don't involve any new money except for maybe closing costs, loans that are part of workout plans to help struggling borrowers, loans that are specifically meant to facilitate the sale of a bank's own real estate, also known as ORE, loans that take real estate as additional collateral just to be on the safe side, and loans that are used to finance permanent improvements. But those improvements aren't the primary collateral for the loan. All of those are exempt from the LTV limits.
Okay.
And for purchase loans, the value that's used in that LTV calculation, it has to be the lower of either the actual purchase price or the bank's own estimate of the property's market value.
Right.
That's another way they make sure things aren't getting overvalued.
Yes. All right, so one last time, let's reiterate how purchase loans are valued for this purpose.
So with purchase loans, when the bank's figuring out the loan-to-value ratio, they have to use whichever number is smaller. The price the borrower is actually paying for the property or the bank's own appraisal of what the property's worth on the open market.
Gotcha.
It's just another safeguard to make sure they're not lending too much based on an inflated value.
All right, so we just zipped through a ton of information on key loan concepts from the study guide. Hopefully that helped to solidify your understanding.
Yeah, I hope so too. It's important to see how all these pieces fit together, how everything from underwriting a loan to classifying it and following all those regulations, it's all connected.
It really is. And here's a final thought for you to ponder. We've talked about how all these loan concepts are interconnected, but have you ever thought about how even a small change in one area can have ripple effects across a bank's entire risk profile?
Right.
Like, what if they tweak the definition of what a related interest is under Rego? Or what if those supervisory LTV limits shift just a tiny bit? How would those seemingly minor adjustments change the way regulators view that bank?
It's a good question.
Just something to think about. And with that, stay tuned for our next deep dive.
See you next time.